Dynamic rebalancing. Basically, anytime money flows in or out of the portfolio, it rebalances the portfolio. What this means is that everything in your portfolio is going to behave differently at different times. So even if you started off with a 20% even split of FANG, 6 months later, it's most likely, it's almost guaranteed, not going to be that same 20%. One of those stocks is going to do better than the others, and maybe that's going to now carry 25% weight. And then maybe one of the stocks didn't do so well, so now you're underweight, sitting at 15%. A lot of people never really think about portfolio diversification, and this can cause you to be under diversified, or it could have you overweight in certain stocks without even knowing it, just because of how much they have gone up since you purchased them. So if you were to add money to your M1 portfolio in the form of a deposit or earned dividends, assuming you have auto invest turned on, they're going to automatically buy whatever you are underweight in. So basically, in that past example, whatever stock that you now only have 15% allocation of instead of 20, it's going to buy more of that to try to bring you back up to that 20% level. On the other hand, if you take money out of your portfolio and you sell, it's going to sell whatever you're overweight in. That way, they're trying to return you to that even 20% split or whatever you set previously as closely as possible. So as long as you are consistently adding money to your portfolio in the form of deposits or dividends, it's basically going to do its best to keep you as close as possible to those target allocations. Now, you can manually rebalance your entire portfolio. However, do keep in mind that can result in some short-term capital gains, which is something that you may not want to pay because it's basically higher taxes on a profit from the stock market, whereas if you held it for longer than a year, you'd pay a lot less in taxes.